Hello there and welcome to Business Bullet. I'm Robert Miller. And yet again this weekend, officials from the Eurozone and International Monetary Fund will be working on the much-delayed second rescue package for Greece. The inspectors have already criticised Greece for failing to implement agreed debt-cutting policies promised in the first £96 billion bailout. This includes not collecting as much tax as envisaged, and the Greek economy has done worse than expected. Well, that's hardly a surprise, is it? Meanwhile, the Eurozone governments are haggling over what sort of collateral Greece should post against the loans. And Germany's constitutional court, remember, must deliver its verdict soon on whether the financial assistance Germany gives to these heavily indebted countries is actually lawful. And all the while, Spain and Portugal in particular are struggling to avoid the humiliation of having to apply for help. It's just not going to work. Unless there is far more direct action by the Eurozone's political and monetary authorities, there could be a combined sovereign debt and banking crisis. It really is that serious. Now, if you are out and about trading in the markets, just watch out for the bears. They came out in the final session of Asia trade and they're roaming around Europe's bourses at the moment. So, whatever your diligent research tells you about seemingly undervalued companies, be careful because there's little real corporate news around, so it's still geopolitical events like the Eurozone crisis that dominate sentiment. There's also concern about what President Barack Obama can deliver in his promised economic revival plan, which is coming soon. Given the political headwinds he faces on Capitol Hill, President Obama will be grateful when the US Federal Reserve Bank launches QE3. But beware, that implicit assumption of Fed intervention is already partly written into share prices. And appropriately enough, given the market volatility that's around, the London Stock Exchange itself is in the news. The LSE has confirmed it's in early stage talks to buy its main clearinghouse for deals in UK stocks and FTSE index futures LCH ClearNet. ClearNet, remember, is majority owned by its bank and broker customers. Having failed to buy the Canadian exchange group TMX in the summer, this would make sense for the LSE, and it takes place against the backdrop of the proposed merger of Deutsche Börse and the combined New York Stock Exchange and Euronext group. If the London Exchange fails to pull this deal off, then it won't do its current share price of around, well, it's sub 950p at the moment, unless, of course, it becomes a bid target itself. And there's a very good chance that would happen. Finally, a quick look ahead to companies and events in the news next week. The standout for half-year results anyway will be the supermarket William Morrison, and that will provide a very useful snapshot into consumer sentiment, buying habits and margin pressures. And the same applies to the annual figures from the chocolate maker Thornton's on Wednesday and the pub group JD Wetherspoon on Friday. But on Thursday, it's all eyes on the Bank of England's Monetary Policy Committee. Rates will obviously be held. And I've already said here that I think there will be another £50 billion round of asset purchases, or another £50 billion, I should say, round of asset purchases, or QE, but we may have to wait until October or November. And don't forget, the US stock market will be closed on Monday because of Labour Day national holiday, so enjoy that one if you're there. And that's it for this week, but we'll be here online to bring you all the latest news. And of course, you can catch up with our commentators and columnists in the Saturday and Sunday Telegraphs. Thanks for watching. Have a wonderful weekend. And please join us again at 11 a.m. on Monday when Suman Bhatia will be here.